Most advice says to claim Social Security as early as you can or delay as long as possible until age 70, but the truth is smarter and more profitable than either extreme. If you're in your early to mid 60s and thinking, how do I retire now but still get the highest Social Security benefit later, this is for you. In this video, I'll show you the retirement bridge strategy and how it works. You want to use your taxable accounts first, partial Roth conversions, and even part-time income to cover spending between retirement and age 70. Done right, this approach can raise your lifetime after-tax income, lower future tax bills, and protect your spouse with a larger survivor benefit. And before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. So what is the retirement bridge strategy? Well, it's a coordinated plan to retire on time or early while you delay Social Security to a later date. And why would you want to delay? Well, because for every year you wait after your full retirement age or even after the age of 62, your benefit will grow with delayed retirement credits. The larger check lasts as long as you do, and if you're the higher earner in a couple, it also sets the floor for your spouse's survivor benefit. The bridge covers your income gap from age 62 to 70 or 65 to 70, depending on when you retire, without locking you into a suboptimal tax position. Think of it as three levers you can mix and match. First, you have your taxable accounts in cash. Next, you're going to utilize your traditional IRA or 401k to convert it to Roth dollars during those low income years. And then you could add in part-time or consulting income to lighten the withdrawal load from your portfolio over time. So why does delaying pay off? Well, the first reason makes logical sense. You get a bigger monthly benefit for life, and delaying often pushes your break-even age into the early 80s. Live beyond that, and the higher check can produce tens of thousands of dollars more in lifetime benefits. Even if longevity is uncertain, the bridge gives you flexibility. If markets stumble or you need income, you can claim earlier, but having a plan to wait keeps the option open. It also provides you with protection for a surviving spouse. If you're the higher earner, your delayed benefit can become the spouse's survivor benefit. In practice, one higher check that lasts for the second life is worth more than two smaller checks that end with the first passing. It also gives you a tax planning window. Retiring before 70 usually creates several low-income years. That's prime time for Roth conversions, capital gains harvesting at low rates, and keeping Medicare and Social Security taxes under control. But let's be clear about one thing here. If you need the money to survive, delaying Social Security is probably not best for you. If you could use the extra $1,000 or $2,000 a month to pay your bills and meet essential needs, this advice will not work for you. This advice is specifically for individuals and couples who have done a good job saving, so much so that they are unlikely to spend all of their hard-earned dollars. And if they claim Social Security early, they will be foregoing tax savings that are a multiple of their annual benefit over the course of time. So if you've done a good job saving and one spouse earns significantly more than the other, or there's a big age gap between spouses, or you want to leave money to someone or something tax efficiently, after you're gone, this advice is for you. So the first step in this strategy is to define the gap. You want to start with your retirement spending target. Subtract any pensions or guaranteed income that you receive, and what's left is your annual bridge need until age 70 or till you claim Social Security. For example, if you need $90,000 before tax and have $15,000 from a small pension, your bridge is $75,000 a year. Multiply by the bridge number of years and sanity check that against your portfolio and risk tolerance. The goal isn't to spend less, it's to spend smartly. And this part is so important. So don't just factor in your monthly expenses. Factor in the vacations you want to take, the gifts you want to give, and add a little extra for emergencies that may pop up along the way. Having a solid understanding of your entire income needs allows the planning to mitigate taxes during these bridge years easily and effectively. The second step of this strategy is to sequence withdrawals for tax efficiency. A simple baseline order that often works is as follows. You want to tap your taxable brokerage account first, spend dividends and interest, then tap into principal. This can let you realize long-term capital gains within favorable brackets, even the 0% bracket. You want to use your Roth last because you want to keep Roth dollars compounding tax-free for as long as possible. And in the middle, that's when you use your traditional IRA, but strategically. Use targeted withdrawals or conversions to avoid future required minimum distributions piling up on top of Social Security later on in life. your numbers are going to tilt the order. If you have a large pre-tax balance and few taxable assets, you'll likely lean into conversions early so RMDs don't force you into a higher bracket later. And that's why this is so nuanced. No two investors are the same, and no 2 years for the same investor are even the same. So this is likely different than what your friends are doing or what your family's doing, and if you're doing this correctly, it will be different from year to year for you as well. Next, we're going to want to utilize Roth conversions to shrink tomorrow's problem. During bridge years, your ordinary income can be purposefully low, which creates space to convert IRA dollars to Roth at attractive rates. Each dollar you convert today is one less dollar the IRS can force you to withdraw later on. Benefits from this include lower future required minimum distributions beginning at age 73 or 75 if you're born after 1960, more control over your tax brackets and Medicare premiums in later years, a flexible, tax-free bucket you can tap into during market dips so you aren't forced to sell stocks in a downturn, and when it comes to legacy planning, there is nothing more tax efficient than a Roth IRA you can leave after you're gone. You want to plan conversions annually, decide how far to fill the bracket without tripping into undesired thresholds. Pair conversions with capital gains planning in your taxable account so you don't accidentally crowd out the 0% capital gains bracket. Next, you could also consider part-time work as an income force multiplier. Even $15,000 to $30,000 of part-time or consulting income can meaningfully reduce what you must withdraw each year, which in turn increases how much you can convert to Roth without moving up a bracket. Flexible work can also preserve purpose and routine as you transition out of a full-time career. The goal is not to work forever, it's to buy time for your benefits to continue to grow with the least amount of tax friction. The next step is to protect yourself with an income buffer. Sequence of returns risk or the danger of a bad market right when you start withdrawals is real. Build a cash or short-term bond buffer covering 12 to 24 months of spending. Then layer the next 2 to 4 years with higher quality short to intermediate term bonds or a treasury bond ladder. This structure allows you to ride out market downturns without liquidating equities at poor prices, while the long-term stock sleeve compounds for the back half of retirement. The final step is to coordinate with healthcare and tax thresholds. If you retire before Medicare begins, mind the Affordable Care Act subsidy cliff. Small changes in income can have outsized effects on premiums. After 65, watch the Medicare income brackets that determine surcharges. During your bridge, you want to fill brackets thoughtfully, but not so aggressively that you create downstream premium spikes you didn't plan on. Likewise, be cautious with realizing big capital gains in the same year you convert heavily to Roth. Crowding everything into 1 year can push you out of optimal zones. When thinking about IRMAA surcharges on your Medicare, they are important but not the first point of optimization. If you have a sizable portfolio, sometimes it will make sense to cross 1 or even 2 of the thresholds because the tax savings on the other side justify paying higher premiums for a year or two. This is where a good planner can help you walk the balance of where the optimal point lies and guide you there. Before we dive into a case study, please don't forget to hit that subscribe button and throw this video a like. We appreciate all the support and don't want you to miss out on any of our weekly videos. Let's jump forward to the case study. So we have Marie and David who are both 63 and want to retire right now. Target spending is $120,000 a year pre-tax. They have $1.6 million invested, $700,000 in a traditional IRA, $300,000 in a Roth IRA, and another $600,000 in a taxable brokerage account. Maria is the higher earner of the two for Social Security purposes. We're also going to assume that they take the standard deduction of $31,500 for 2025. We also know that if they keep their taxable income below $96,700, they will pay nothing on capital gains during the course of this year. And finally, if they stay below that $96,700 threshold for taxable income, that will leave their ordinary income taxed at a 12% rate on their last dollar. So let's build out their plan. Their bridge plan would look like this. The first thing they want to know is how much income they can realize from sources to stay under those thresholds. So we would start by taking the $96,700 capital gains threshold and adding to that their standard deduction of $31,500, which means their total adjusted gross income, or AGI, before their deduction would be $128,200. And all this means is that's how much income they're going to realize during the course of this year to stay within the bounds of those thresholds. First, Marie and David are going to spend from their taxable account. They're going to harvest $25,000 worth of capital gains while intentionally staying within the favorable capital gains thresholds. And let's assume that frees up $60,000 worth of cash for capital for them to spend during the year. So we've figured out where the first half of their spending income is coming from. And second, we know that since they realized $25,000 worth of gains, their adjusted gross income threshold would be reduced by an equivalent amount, which means that they could still realize taxable income for Maria and David in the amount of $103,220. Next, David does some light consulting work and earns $18,000 a year doing this part-time, which reduces withdrawals and lets them keep conversions steady even during a market dip. This leaves them with $85,200 left in their taxable income buffer and has met $78,000 of their total spending need for the year. Now we have a decision to make. Where are they going to get the remainder of their income from for the year to spend? This is where we would go back to that taxable brokerage account and free up more capital tax efficiently. Let's assume they can free up the extra $42,000 needed for spending by realizing an additional $10,000 worth of capital gains. So we've met their spending need of $120,000 pre-tax and still have $75,200 of ordinary income to realize from Roth conversions. This would leave them in the 12% tax bracket for the majority of their conversions on the ordinary income purposes, and they'll still be in that 0% capital gains tax bracket. So now we're going to convert that Roth each year. With no wages and no Social Security yet, they convert about $75,000 this year at lower tax rates. They will go through this exercise annually, but for the sake of simplicity, let's just assume they follow the same sequencing and dollar amounts until they claim Social Security. In this instance, they would have moved over $500,000 from traditional IRAs to Roth by age 70, and their tax bill each year was only about $8,500, or an effective tax rate of right around 6.5% on their $128,200 of taxable income. That is real tax savings. And at this point, we know that we've done a great job reducing their tax bill this year. And we haven't even factored in how much money they're going to save over the long run through those Roth conversions and efficiently realizing the taxable gains. That's a conversation for another video, but if I were to estimate, I would assume that's a few $100,000 in additional savings, if not more. And that's the beauty of this strategy. Because you're doing such a great job on the front end, you're making the tax efficiency on the back end even greater. This does not include any extra risk or special investments you've never heard of, just sound planning that will save you real money over the course of your retirement. So I've talked a little bit about why I like this strategy, but let's talk about what could go wrong and how you can avoid these pitfalls. The first is over-converting in 1 year. Big conversions can bump you into higher brackets and increase Medicare premiums later on. Spread conversions over multiple years and monitor thresholds as you go. Next, you want to make sure you're not ignoring the Social Security tax trap. Once you start Social Security, certain income increases can make more of your benefits taxable. Avoid stacking large IRA withdrawals or big capital gains in those years unless it's intentional. Next, if you're letting your portfolio drive the plan, you're probably doing something wrong. Your withdrawal rate and your tax plan should drive rebalancing, not the other way around. Set guardrails, rebalance into weakness, and refill your cash bucket after strong markets. Next, if you're claiming too late without a bridge, if you don't have a realistic income plan between now and age 70, you may end up selling investments at bad prices or abandoning the delay at the worst time. Build the bridge first, then choose your claim date. Finally, if you're not following through on this every year, you are going to be a loser. Consistency is key here. This is stuff you can do yourself, but it's also something a planner can do for you for a few $1,000s a year or as part of your asset-based fee. The key here is to make sure the tax savings is worth more than the cost of working with someone over the long haul. So if all this sounds good to you, here's how you can build your bridge in 5 easy moves. First, map your cash flow from now to 70, spending, healthcare, taxes. Identify the annual gap that you need to fill. Second, inventory your accounts by tax type and decide a default order of withdrawals. Plan a 12 to 24 month cash buffer and a short-term bond ladder as part of this. Third, schedule annual Roth conversions that fill your preferred bracket without tripping avoidable thresholds. Revisit the plan each fall before year end. Fourth, decide if modest earned income helps. If yes, pick something flexible that you can stop once your Social Security starts. Finally, document your claiming strategy, including the survivor plan. Rerun the math each year, conditions change, and your plan should be dynamic. Delaying Social Security isn't about gambling on living to 100. It's about buying a larger, inflation-adjusted paycheck the most tax-efficient way possible, protecting a spouse, and creating flexibility for later years. The Retirement Bridge strategy lets you do that with intention rather than hope. If you want help designing a bridge that fits your numbers, your taxes, and your goals, that's exactly what we do here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.